Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, August 9th, 2022. Welcome back to the podcast, George.
Great to be on, John.
Always great to have you. So the latest, I would describe as blockbuster jobs report, looks to have focused market participants squarely back on the drawing board, vis-a-vis projecting that the Fed would pivot from focusing on high inflation to weak growth. Obviously, that's a soon conclude or too soon conclusion. It's kind of at best at this point. But with such a strong with such strong headline payroll growth, as well as higher wage inflation, it's really hard to see how the Fed can pivot anytime soon. Instead, it seems like they might even need to deliver more hikes. We've obviously seen some of that price action, in the last few days. George, what are your thoughts about the jobs data and how the markets have reacted since?
So I do think that the markets have, at least got a rude awakening in the light of the stronger NFP report. I do think at face value, I think it does make the job of the Fed much more difficult in the weeks and months ahead. And we do have another NFP as well as a CPI report upcoming, as well as another one before the September meeting. So there's still some additional data points that could still influence the Fed's decision. But I do think it serves as a stark reminder that the Fed perhaps has to go even more aggressive at trying to impact aggregate demand, and as well as ultimately result in slower job growth. And what they've done so far perhaps hasn't been enough. And so I think the markets that were reading into the post FOMC meeting in July as typical Chair Powell comes across as sounding dovish, but yet they're hiking at 75 bips clips. So let's not make any joke about that. I think that market overread it and thought that the Fed's about to pivot, and those trades have been largely or in the process of being unwound. And I think that there's still some anomalies. I think that the equity market is still kind of trying to modulate between, good news is good news and bad news is good news, between if the Fed's not going to hike as aggressively, and that's good for overall risk appetite. And if the economy is that strong, then that's also good for risk assets. I think that's still happening, but I think clearly in the rates market, the shock, twice last week where we were trying to make a run for lower rates, failed, especially in the front end of the curve. I think that's, it was the right direction. We were, as skeptical that the Fed was ready to pivot. It's too soon to make that call. And so I think the market reaction was the right one. Now, reading between the lines and looking more closely at the data, it's possible that we've seen the peak in job activity, and that could have been the final hurrah, similar to perhaps we've seen the peak of inflation. We don't know yet. But either way, there's some negatives in the number, but it's that's just nitpicking more than anything else. The fact that we still have job growth and wage pressures and a lower unemployment rate, which factors extensively into Fed thinking, and their Fed models really rely on the unemployment rate. As long as that's happening, they're going to have to lean harder, and I think that's going to really shock the markets in the next 2 or 3 months.
Yeah, and you were obviously out in front of that call of the market being really too dovish on the Fed. So that's certainly that this past Friday's employment report is a good reminder of that, as you said. So as a reminder to our listeners, we're recording this episode one day ahead of CPI. It's likely that by the time that you listen to this episode, you will have received the latest inflation readings from the U.S. But George, here we are, where we are now, we're sitting in between, non-farm payrolls and just before CPI. What are you looking for from the CPI report, and how should investors and markets react in following and in the days following the release?
I think expectations are pretty high that maybe headline has peaked, and that we've seen a rollover in commodity prices, and that's going to factor into the July, August, maybe September readings, and that perhaps that means that the energy component and some of the other food components that have been driving overall headline inflation are coming off. And so we should expect headline to come in a little bit. But that, again, we collectively, I'm saying, and not us as MUFG, but just in general, the markets have been trying to pin when the peak has happened. We've got it wrong twice already. So who knows what tomorrow brings? But we're still seeing a very high 8%, upper 8%, 8.7, anywhere between 8.5 and 9% tomorrow's fair gain. Anything under that, I think that that could elicit a stronger reaction in markets that peaks have happened. But at the same time, though, the underlying broadening of inflation pressures, which is better captured in the core component, which is really what the Fed cares about, even though they're not targeting core CPI, it does kind of factor into core PCE and to a lesser extent. And so, if the core number were to come in either at consensus or stronger, I think that could outweigh the lower potential headline because we know it's just more kind of mechanical on the commodity side. So I think tomorrow really will usher in the flip back to focusing on core more so than headline. Headline's been capturing the attention of both the media, politicians, and markets for the last year because we've been seeing these really large numbers that are like multi-decade, 40 plus years of super high inflation. But I think we shift back towards focusing on core, and if core remains sticky and it's not showing signs of heading lower, that just again further compounds the the challenge that the Fed faces at trying to really corral inflation. So I think that's tomorrow's probably potential inflection, moving away from headline concerns back to the core, but yet core is not moving in the right direction. If that happens, I think then a curve flattener has been and has continues to work as the preferred kind of medium for expressing these views. It's quite possible that the curves get to really outrageously flat levels. We were approaching the -50 on the 2s10s curve. In historical times, in pre 1990s, in the 70s and early 80s, we had curves that were in the -100, 150. So anything's possible. I mean, levels of rates were much higher back then too, but nonetheless, you can have a situation where the Fed has an acute inflation problem and has to hit the rate hikes even harder, but yet that will then perversely create the risks for them doing too much or the economy softening too fast, then falling into a recession, and then that will keep the back end of the curve not responding as much. But having said all that, I do think that we'll get to a point, especially in the coming weeks, at the September meeting, especially once the Fed gets rates in the front end north of 3%. I think it's going to be hard to have a negative carry trade in place and have the overall term structure trade under 3. And then when that starts to happen, and then all rates start to move, not necessarily in a parallel fashion, but just kind of commensurate with some sort of beta to the Fed hikes, then that is when I think the rubber hits the road and starts to really impact credit markets and then ultimately equities, and that could be more of a fourth quarter phenomenon. But I think we're in this ambiguous period, as we've been calling it, where the bond market tries to rally. We have also a 10-year auction happening on the same day. We have a 30-year bond, and then we've had a lot of overall issuance in the fixed income space. In credit, we're getting towards the middle of the middle of August by next week. Things typically start to slow down, and that will be probably a point where you can see markets drift sideways or maybe rally just because there's really no direction. But I think once September comes back, I think we'll see markets really zoom in and focus on the near and present danger of really higher rates.
Yeah, well said. So to summarize, the headline, a softer headline print could elicit a stronger reaction than a stronger one, but you think the market focuses on core, which all indications are it should tick up a little bit. The CPI report and this week's auctions are going to cap a busy, sort of week and a half or 2 weeks of activity. Hopefully things die down in time for us to take a little bit of time off and rest and recharge as we get ready for September. So great stuff as always, George. Thanks so much for coming on the podcast.
Thanks, John.
And a reminder to our listeners, if you are not receiving George's strategy reports, please do get in contact with George directly. And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.